So today we're here with Chase Altig. He's a good friend of mine. He's a lender in town, and we're going to learn about more of what he does in the community and how he goes about doing his business, and maybe a little bit about real estate investing as well. So without further ado, Chase, welcome to the show. Maybe just tell everyone who you are, where you're from, what you're doing here in Spokane.
Yeah, absolutely. Thanks for the introduction. My name is Chase Altig. I've been a lender here in Spokane since 2013. Got into the business right out of college. Been with the same group. We've been through a couple different company changes, but overall, we have all stuck together, throughout many seasons, and we're here still doing loans today.
Right, right. So, okay, so you started right out of college. Most people aren't
Yep.
doing the same thing that they were doing out of college, say 9 or 10 years after. So, how did you know what you wanted to do, and how are you still doing what you're doing? Because people bounce around all the time.
Yeah, so for me, it was a good fit. I looked at private banking as one option, as well as like life insurance sales, and then the mortgage industry itself. So my family and my father was actually in the mortgage industry for 22 years,
Wow.
and he thought it would be a good fit for me. As far as sales background goes, wanting to be an entrepreneur and basically have that work life balance as well as be able to run my own business. And so after meeting with the team here at the time it was Home Street Bank, was a really, really good fit. My mentor was a guy who I actually detailed his cars when I had that business going on through high school. So somebody that
Nice.
I was familiar with that saw that I could be coachable and then teach me along the way. So that's how I fell into it. I've loved it ever since. And so there hasn't been a thought of going a different direction as far as careers go, which is why I'm still here.
Right, right. Okay, and so as a realtor, I know that people will say it's easy to sell a house, or it's easy to do certain things because they may just see that you help them buy the house and then you get to closing, but they
Yeah.
don't see all the in between motion and action that's happening. So say that you're
Yeah.
explaining what you do on a daily basis. Like what does that look like? Because I know it's not just you hit approve for someone and then that's it.
Yeah, so there's so much stuff that goes into like actually making a loan application. So if somebody calls me, the first thing that we do is collect all of the pertinent information for the application itself. Um, there's three big components. So it's credit, income, and assets. And that makes up all home loan applications. And we'll look at all of those components and then try and kind of work in reverse as far as what can you afford and what does that put you into as far as a mortgage goes, which then whatever your down payment is ultimately determines how much house you can buy. Um, so that's step one is gathering the pre-approval, making sure that they have credit history, whether it's good or bad and whether we need to work on it. Income, what does that look like? Self-employed versus a W-2 employee. Are you salary? Are you hourly? What's the structure there? And then what do you have as far as funds for a down payment goes? Is it money that you saved up that's in the bank? Is it funds that are coming from the sale of a real estate asset? Are you using a down payment assistance program? Or are you getting gift funds? And then basically compiling all of that and then determining what options best fit somebody's long-term and short-term financial goals.
Right on. And so just to touch on something, so when you were our lender and helped us get into a home, we were self-employed at the
Yeah.
time, and that was a whole new
Yeah.
process for us. And so maybe for those that are self-employed, what's the process for that? Because it is a little different. It's not just hand over your W-2 and off to the races. There's a little bit more involvement, and it could take what, like 2 years? We had to have 2 years of pay or tax returns.
Yeah, so that's the big thing with self-employed income is you have to have a history of it because it's something that can fluctuate year to year. And then obviously most people hire a tax advisor or CPA to help them through their taxes and accountants are good at making sure that you pay less in taxes, which means that you show less in income, but on the mortgage side, we may need you to show more in income. So it with self-employed, 2 years history is a big thing, making sure that you have that. And then if you are planning on buying a home, talk with a lender and talk with an accountant and come up with a game plan to set yourself up so that when the time is right for you to buy, that you're in a position to do so.
Right, right. So I'm sure you come across this. I have a couple questions because I'm just curious. You've been doing this so long. What's the worst thing you
Yeah.
can do once you get approved and you're making offers on a home, or say you go under contract? Like, what's the worst thing that you can do? Can you blow up a deal?
Yeah, you can. Taking out new debt is one of like the worst things you can do
Okay.
because it can affect credit. And depending on how long it took you to find that home, we may have to repull credit if we're outside of 120 days. And then most companies do what's called like debt monitoring
Mm,
and will pull up any new debt that you've acquired after applying for a home loan. And if you take out a car, a loan for a car and you now can't afford the mortgage, you're toast and you could lose your earnest money. Like that is probably the worst thing that you can do is to acquire new debt. Utilizing your own credit cards, and we're not telling you to just totally stop spending
okay.
because that's what people do. They're in their own habits. But yeah, taking out new debt is probably the worst thing you can do. A lot of people say don't switch jobs, and by all means, that's another one. Don't go from a W-2 job to being self-employed, or a W-2 or like a salary position to a commission position, because that can affect your approval. But I never want to tell somebody don't take a job that is going to better your position. If it's hey, I'm at company A and company B is now offering to pay me more and it's in the same line of work and it's the same line of work I've been doing, go for it and we'll figure it out.
Okay. Okay. So it's just like just hold off for a month or two before you go before you
Yeah.
go take out debt. Okay, so that can blow it up.
Yeah, the big one. I mean, it's almost always car loans, and I try to tell people like you don't want to have a new car and not have a new home driveway to put it
Yeah.
in, right? Like you can't have. I mean, you may be able to make both pencil out, but just try to avoid it.
Yeah. I feel like that was the case back where I was from. There would be, some really smaller homes and they would have like a brand new Camaro outside or, something like that. And I'm like, man, you should
Yeah,
you should like get rid of the car and like get a bigger house. I don't know, maybe they didn't care. Maybe they love cars, but I was like, that has to be a huge factor in determining your borrowing, limit.
it totally is. And one of the biggest things that we see, and honestly, like, not only don't do it during the process, but if you plan on buying a home in the future, don't do it before, because that debt is something we have to factor into your overall debt to income ratio. And like the average car payment in the United States, I think is around $700 a month, which is
Yeah.
insane.
Oh, it's crazy.
But that translates to almost $100,000 in purchasing power. And a lot of people don't realize that, where they're like, oh, hey, it's $500 a month, or it's $600 a month, or $700 a month. And they take on that debt, not thinking of the long-term impact that it has on their ability to qualify.
Yeah, it's crazy how we make decisions and we if you don't know the facts like what you're saying, you could totally think that you'll be all right. And then you go to buy a house and you're
Yeah.
you're you're sadly mistaken. Um, so I know a lot of people are probably interested, as we both are, but like the market right now, what are you seeing right now with mortgage rates? You got any hope for us? Any trends?
Oh,
What's
man.
going on?
Mortgage, yeah. So mortgage rates themselves right now, I mean, if you turn on the TV, like, or just read any sort of article or even talk to a friend, they're high. Like, there's no doubt about it. Yes, historically, they are still below long-term averages.
Yeah.
But as of like the last 2 weeks, I mean, rates have gone up and you could get a loan at a rate of 8% right now. It's not out of the question. So for me, it's there's it creates hurdles for buyers, and I totally empathize with buyers right now. It's that affordability factor is a very big challenge. Like there's no doubt about it, but
Hmm.
there are creative ways to work around it. Whether you do a permanent rate buy down, a buyout of your mortgage insurance, or if you do a temporary rate buy down. But it's very challenging in that aspect as far as where rates are at right now.
Okay. Is there a way that we could just like you could walk us through, say someone the rates are 8%. can you walk us through
Yeah.
a scenario where we could get that down and have a more manageable mortgage payment? Like, how does that work?
Yeah, so one strategic way is to ask for a seller credit. Um, most of the time, and in our market right now, sellers are willing to make a deal because they need to move on to their, either the next home or their next venture, whatever it may be,
Hmm.
and they're willing to play ball. So you, as a buyer, have the ability to negotiate on a contract a seller concession, and you can take that money and apply it towards your closing costs, which will reduce your out of pocket cost. Or you could say,
Right.
hey, that's not a hurdle. I have my money saved up for my down payment and I have my money for my closing costs, but
Yeah.
can I use it towards a rate buy down?
Mm.
And that money will go a really, really long way. You may be able to lower your interest rate by, 0.75%,
Okay.
depending on how much seller credit you get.
Right. Okay. And that can make a huge difference, even 3/4 of a percentage point, right?
Yeah, I mean, 1%, like the rough estimate is basically if rates drop by 1%, your buying power improves by between it's 11 and 12%.
Wow. Wow. Okay. Um,
Yeah, so I mean, if you were shopping at 300 and you gain 10%, I mean now you're at 330. It's a pretty
yeah,
big jump.
that is a difference for sure. I think we both agree on this, but say someone is ready to buy a house and they can afford it at this rate, but they decide, I think we should wait until maybe interest rates go down.
Yeah.
I guess the thing that I think about is if they go down, like more competition, higher prices. So if you can already afford the house you
Yep.
want right now, why not buy it? And then if rates do go down, you can just refinance and get the rate you wanted. Like, how are you talking to
Yeah.
buyers and what are those conversations looking like?
Yeah, so that's a challenging conversation because we don't know where rates are going to go. And obviously the expectation is that when inflation comes down, rates are going to come down. But what does that timeline look like?
Yeah.
So for somebody who has the ability to buy right now, negotiate a deal, either whether that's, getting seller concessions or a reduction in your purchase price, you could pick up something in this market and feel good about it.
Hmm.
Yes, the rate and the payment may not be ideal, but maybe you
Yeah.
got to buy down on your rate, whether that's permanent or temporary. But the expectation is if rates come down, there's going to be a flood to the market. There's all this buyer demand that's out there right now. People are going to jump back in. I mean, there was an article from Housing Wire, The Real Deal. I can't remember who it was, but it said 5.5 is the magic number. And
Uh,
if rates come back to 5.5, how many more people are going to step back into the market? Is it, 1 million? Is it 5 million? Is it how many more people become eligible to buy when rates are that, at that point?
right.
And then you're going to have a flood and a surge of buyers back into the market, which then could drive prices back up, which then you're getting a lower interest rate, but the home you're paying more for.
Right.
So it's a give and take. And I get it. Everybody's situation is totally different. Some people are ready to buy right now, but some people may need some more time to save up or feel like they're in a secure spot. So,
Hmm. No. Yeah, that makes sense. And I mean, obviously, yeah, it's case by case and everyone's going to be different. There's homes being sold right now, which is great, obviously for all of us. But yeah, I'm just curious what that's going to look like when all these buyers do come off the sidelines, because as you can see, all the data, all the numbers and the trends, they've dropped off a cliff, compared to what they were.
yeah.
So you just know that, life moves on and basically people buy and sell homes, and so you have all these people that aren't buying and
Yep.
selling. It's gonna snowball. It's gonna happen, and so it'll be interesting. 5.5 seems like a good number. um I'm gonna kind of shift gears a little bit because in a market like this, everyone wants to be a real estate investor. Most people would love to have rentals. They want to own real estate. They know that that is one of the keys for building wealth over time. And I know that you are a real estate investor and have some rentals. And so I guess I'm just curious,
Yep.
like, how did you get into that? I know you kind of grew up in it. But yeah, tell us
Yeah.
more.
So the one of our homes, and it's it's a strategy that I talk about quite often, which some people refer to it as the house hack, where you purchase a primary residence, putting the minimal amount down, and then
Which
live in
is
that home for a year.
okay.
And in
Okay.
our case, we lived in it for 7 years, 8 years, and then saved up enough for our next down payment, and then bought our next home, and then turned our old home into a rental property. And what that allowed us to do is, keep our mortgage payment low because we bought it as a primary residence. Primary residence rates are lower than investment rates. Our
Hmm.
initial capital investment into the property was pretty low. We did some renovations to the home. We added two additional bedrooms, a bathroom, and then a second family room in the basement,
Mm.
which helped make it more marketable in our area. And yeah, that property now cash flows at like $800 a month. So
Hmm.
that's one strategy as far as that goes. And our down payment and where that we bought, it was a 0% down loan. Like it wasn't
Wow.
anything crazy. It was a USDA loan. So
Yeah.
our our initial investment in the home was, I think that we got, I think we got $800 of our earnest money back, or $500 of our earnest money back, and our earnest money was, I think, $1,500. So almost all of it back. So it was
Wow.
like the low barrier to entry. But the strategy you could utilize over and over again. If you're somebody who's motivated and want to build a real estate portfolio, and
Yeah.
maybe you have some cash set aside, this is a really great option. You could put 20% down on one property, or maybe you could span it across four properties and put 5% down on each one. So
Yeah.
that's
Tell me more
it's
about that.
the house hacking strategy.
Yeah, tell me more about that because a lot of people think that they have to put 20% down. And so right off the top, they're already like, I can't do this. I cannot be an investor because how in the world am I going to
Yeah.
save up 20% every time I want to invest in a home? So how can they make that happen?
Yeah, so if you're an owner occupant of the
Mhm.
residence, the minimum down payment required on a conventional loan is going to be between 3 and 5%. And if you're a first time home buyer or somebody who falls into one of their income based programs, then you're eligible for 3% down. So if you planned on it, just 5% would be what your initial down payment is. And that can be every single time you buy a primary residence. And you have to, as a primary residence, you have to occupy the property for at least 1 year. At that 12
Mhm.
months, you can go out and buy another one and do it again and again and again. And
Right.
one of the big things that was a change that is going into effect in November is you can now put 5% down on multifamily properties. So
Makes
in the
sense.
past, for a 2 to 4 unit home, if you wanted to do minimal amount down, you had to go with an FHA loan, which was 3.5%. But
Right.
there's some other factors when qualifying for an FHA loan that you have to take into consideration. It's called self sustainability or self
Mhm.
efficiency, which means that the property has to cash flow at
Mhm.
100% in comparison to the mortgage payment, which conventional loans don't have that. But it made it difficult and challenging to buy FHA properties that were 3 and 4 unit. 2 unit was the sweet spot. Now, conventional has decided, hey, like Fannie Mae, Freddie Mac, FHFA, they've decided that 5% down is the minimum down payment requirement on any property that is between 1 and 4 units, which is
Nice.
huge. It used to be that you had to have 15% down for a 2 unit property and then
Okay.
25% down for a 3 to 4 unit.
Wow.
So,
Why do you
yeah,
think they're doing that now, or that they've lowered the barrier to entry? Do you think there's a reason or?
Yeah. So if you bought a single family residence, so just 1 unit, you can't use any sort of income that the property generates to help offset your mortgage, right? So some people want to buy and rent out rooms, or go that route, which is another house hacking strategy. But if you bought a
Yeah.
2 unit property, you can use rental income or the projected rental income from the unit that you're not occupying to help offset your mortgage payment.
Hmm.
So it may allow you to get more home, or step foot into the world of real estate investing in a very easy manner.
Okay. So say your typical person, they have some cash laying around, they've lived in a house
Yeah.
longer than what, like, what do they need to do to get into it? Because right now, I mean, I look at the market and there's not a lot of good deals, even though the market's slower, there's still not a ton of good deals for rentals. So how do people make it work cash flow wise? How do you find properties? Like what's a good strategy for that?
I mean, the more you talk to people about what you're trying to do, you may find something off market,
Yeah.
or just keep an eye on a property that, is down the street from you. Knock on a door if that's the route you want to go. Or just keep your eye on properties that have been sitting long on market. Some people are, ready and motivated, and then we'll take a low ball offer. But yeah, as far as like the numbers penciling out as being a real estate investor, it's very challenging right now. Just where rates are at, and rental. I don't want to say that rental prices have come down a whole lot, but they've definitely cooled off.
Right. What do you think about long term? Because right now you have long term rentals, right?
Yep.
So long term versus say the short term or Airbnb, VRBO type of rentals. Like the vacation rentals, they seem like a lot of work to me, but I'm not sure. Like what do you think? Are you looking to ever get into a short term?
It's something that I've thought about, but you have high turnover, right?
Hmm.
Potentially higher expenses, but the ability for greater income,
Yeah.
because you can charge more on a per night basis and can earn more. Simply comes down to how much, do you want to manage it yourself? Do you want to pay somebody to manage it? And how much time are you willing to, put into it? I think that, I mean, I have a handful of friends that have purchased short-term rentals in destination areas, and they do quite well. Like they definitely do great as far as cash flow goes. But the other hurdle with that is does the, local government or authority put a restriction on your short-term rental? New York just saw it. There's many places in Hawaii that have a 30-day minimum,
Right.
and it's across the board. So it's something that you have to be cognizant of, but there is massive upside as far as short-term rental goes. For me, long-term rentals are definitely the play. I want to have a handle on it. I'm going to operate in my local market, and be there. But yeah, I've always thought about it, but it's not something that I want to dabble in. But it's another investment strategy. It's not one that I want to take on though.
Right. Yeah. Do you think, I don't know if this is true, but it almost seems like the people who are a little bit more short term focused. They want that fast capital and they want things to be moving and shaking
Yep.
and maybe make more per month than those who are just happy buying a good product or a good property that's going to rent forever. It's low maintenance. You get one good tenant in there
Yeah.
because I think I would be nervous having a rental property where you have all these people. So much can go wrong.
Yep.
Yeah, makes a lot of
Yeah.
sense.
I like that's one of the reasons I like the long term play is that you could have, and I just know it because there's so many landlords that talk about it, that put their loans on 15-year notes. Yeah, they may have taken a slight loss at the beginning, but the loan was paid off in 15 years by one tenant.
Right.
So that's not a bad. I mean, at the end of the day, they're still paying the mortgage. The cash flow thing is, it is what it is. That's not my day to day job. Like if it was, then I'd be acquiring way more rentals and trying to
Right.
span it across.
Right.
But for me, I'm looking at it as a long term play. I'm going to hold this. It's going to appreciate in value. If I had to sell it down the road, I have the equity there. But ultimately, at the end of the day, somebody else is paying that mortgage. So
Hmm. Right on. Have you had any bad tenants?
So I've only had, I mean, both my tenants have been in the property, or the two properties that I've got. One of my tenants, and it was a lot to do with COVID, but
Mm.
they had to go on, rental assistance programs, lost jobs, that kind of stuff. They're not bad tenants per se. It's just, hard times fell on them. And I,
Yeah.
don't want to say I've got a soft spot for people, but I do. And I understand that life happens. But they were able to get back on track and everything's good. But yeah, as far as bad tenants, personally, no. Having grown up around real estate investing, I've
Yeah.
seen some gnarly stuff.
Yeah. I wouldn't even know what to do in that situation. I am like, I'm so like not handy. I it would just be a nightmare. I would be on the phone the whole time. Um, but yeah, dude, can you talk a little bit more? I know you got a cute little family and you love to golf.
Yeah.
Like, what's Chase like?
Yeah, so I mean, for me, I absolutely love being outdoors and in whatever like aspect that is. So playing golf during the summer months is something I absolutely love to do. It's competition against yourself. I mean, obviously there's friendly games that go along with it, but ultimately, like I'm at my own demise, whether it's good or bad. And then if I'm not doing that, like when summer wraps up, it's straight into fall, which is hunting season, which is something that I'm super passionate about. And then when it comes winter time, my family and I, we love to snowboard, and it's a family activity.
Right.
If you asked me when I was like 16 years old what I was going to do, I could have told you that I was going to be a pro snowboarder. That's what I thought it was on my
Okay.
agenda. But that's not where I'm at now. So, and then during the summer, yeah, like spring, back to golf. So that's basically the full cycle of what, I like to do. As far as my family goes, yeah, two little girls, been married with my wife for 9 years now.
Nice.
We were high school sweethearts, though we didn't go to the same high school.
Mm,
But yeah, two little girls, a 4 year old, and then an almost 2 year old. So they're tons of fun.
nice. Yeah, looks awesome. I saw the other day that you went to. I've never been there, but you took your daughter bike riding on that like bike track in
Yeah,
Spokane, and my wife is like, "Yeah, we're going there next week," and I'm like, "Ah, I'm like, I have to miss it," but it looks so cool. That bike track.
yeah.
I gotta check it out.
There was a lot of build up to get her to go
Yeah.
over the but I mean as a 4 year old it's a lot, but like once she did it the first time she was totally committed and wanted to do it again and again and again. So yeah, she loves to do anything that I love to do. So whether that's
Yeah.
snowboarding, we put her on a snowboard when she was like almost 3 years old.
Right.
So this will be her third season, and then loves to bike, but she'll go out and sit in the freezing cold with me
Nice.
if I go hunting. So yeah, I mean she's my little buddy. But
Nice. That's awesome. Okay, so I've been noticing, and this is what I'm doing too. I'm trying to crank out content, getting people to, be aware of who I am and know, like, trust me, because this is a business where that's really important, and also educating people. And
yeah,
so you're cranking out content. What's the plan behind that? Why'd you decide to start putting out more content, showing your face a little more, and getting out there?
yeah. So for me, it was there's been this big push to social media, and that's where so many people are looking. I mean, I don't want to say finding business, but looking for information. Um, TikTok, Instagram,
Hmm.
Facebook, whatever it is, Twitter, people go there versus going to a news site for information. And I'm local, I'm in my market, and video is a great way to have a face-to-face connection with somebody, though it's in a virtual space.
Yeah.
So I started down this path literally probably like almost exactly a year ago, and thought, hey, if there's people out there that are doing it, I can probably learn a thing or two. And so that's what sent me into this whole content creation. um, I've tried to invest money into it to better the videos that I'm making. So I don't have any sort of high quality setup. I use my iPhone. I have a couple lights, a nice microphone, but have been able to pull from other people who are in the industry that are way smarter than I am, who make it really easy to just like, hey, set your camera to this, do this, try this, use this app to
Yeah.
create the content. And as far as what I'm actually putting out there, I want it to be informational stuff, whether that is for the buyer themselves, a seller, the real estate agent, or just good information that I think that somebody should know.
Yeah.
And that's my idea behind it. It's not. I mean, obviously, I'd love to have some business come from it, but that's not the end goal. It's totally educational, which is for me my vision and my why is all based around education. So
Right. I love that. And I think business, even if it hasn't come much from it, it'll start to come because the more that you put out there, the more people are going to see it. They're going to be aware of you. And that was just also my main focus because I came from doing something different. And now I'm just trying to brainwash everyone to knowing that I'm a realtor, you know? Like I'm just
Yeah.
like, I'm not that guy. This is who I am. This is what I do, and I mean it, kind of deal. And so it's I think it's super important. And honestly, I'm like that too. I want to do more educational, simple stuff. Like it would be fun to do the funny, silly stuff that you see on social, but also I think people are there. They want to learn. They want to, get a quick tip here and there and learn what the actual process is because there's so much out there and learning how to, buy or sell or get a loan or what they need to do. I think it's really important. It's big decisions.
Yeah. Yeah. And
So,
I want to put out like quality information that's relevant to the buying process. That person, they may come across my video and they may never like use me as their lender, but if I provided something that helped them get a home, that's a win, right? That's the whole
mhm,
goal, is to help more people become homeowners. I think it's the best strategy as far as investing and creating wealth that there is. And if I help somebody in a, like passing way, it's a win.
right. Yeah, you hear I mean, I'm a student, so I listen to a lot of people in all different, aspects. And a lot of people are like, never buy a house, just rent, and you can go do this or go do that. And I think that works for some people, maybe who are like pretty well off and they live in a nice building and they're traveling. But for the average Joe, paying rent for the next 40, 50 years is not a smart decision in my book.
Yeah, I mean, to each their own. There's some people who say, "Hey, you should never own, your own house, but then have a whole bunch of real estate that ultimately pays your rent," which is
Right.
fine. But my thought would be like, well, why wouldn't you want it to also pay your mortgage and then have another asset that you own?
Yeah.
Yeah, the whole renting thing. Like for some people, renting is the right choice. Like whether
Hmm.
depending on their financial position and where they are at in their stage of life. Like I think renting short term, not like a short term rental, but like,
Right.
1 to 2 years or 3 years for you to get your finances in order and then figure out a game plan on how to buy is super, super important because ultimately, and everybody says this, but like you are paying somebody else's mortgage at the end of the day if you are renting, and or
Hmm.
just, I mean, you're cash flowing to them. So why wouldn't you want to put your money in something that is going to have some sort of return for you over the long term?
Right. Yeah. That's what I mean. My wife and I, we rented it. It gave us flexibility, so we were able to do some things like pay off debt. Um, and we just had the flexibility to say we're not locked down here. We can take our time and find the right house when we're ready. But yeah, it when you're renting it hurts a little bit to keep paying that every month, and you know that's not going towards equity. It's kind of a bummer.
No.
But
Yeah,
okay, so
like having a mortgage and owning a house is like a forced savings plan. Like you're paying on it every single month, but it's money that you're retaining. You're just not seeing it until you sell that property or refinance or you know do something with it. But yeah, it's you're at least building equity.
yeah. Okay, so there's a lot of ways to go about this, but some people say maybe you should make extra payments on your mortgage every month, or some people say, you should invest that money in, say, the stock market, or you can like save money for other rentals. What do you think is a good plan? Say if someone is blessed enough to have extra cash on hand at the end of the month to throw at, different options.
Yeah, I mean, if you don't know what you're doing, and especially right now with where interest rates are at, high yield savings accounts are a great place to park money. So if you're like,
Yep.
hey, I don't know if I want to put it back into my mortgage or I don't know what I want to do with it, start there or talk with a
Mhm.
financial advisor. But high yield savings accounts, some of the rates are like 4.5%. You could generate a lot of money just by doing nothing. So that's one option.
Yep.
Paying down your mortgage like at a faster rate is awesome. You're going to save so much in interest over the life of the loan. even
Mm-hmm.
just by doing the biweekly payment strategy, which is essentially making 13 payments a year, you'll
Oh,
shave 8 years, 7 to 8 years off your mortgage, which is
wow.
huge. And then I mean, the interest calculation is going to be based on whatever your interest rate is, but it's going to be, I mean, tens of thousands, if not $100,000. Like it could be a massive amount.
Mm-hmm.
If you have extra cash and are looking for something to do with it, yeah, you could set it aside in a high yield savings account, build it up, and then go buy an investment property. I mean,
Right.
there's a bunch of different ways to do it. Tackling debt so you're not paying long term interest is a good thing.
Mm-hmm.
If you're not sure what to do with your money, yeah, put it in something that it is earning you money.
Right. Yeah, I think for those people who, yeah, like if you don't know what you're going to do, you know that if you put it in a high yield, like we use Marcus from Goldman Sachs, but you know that that is
Yep,
going up 4.4% every month. And so at least while you're
yep,
waiting, you can like rest assured that that money is going to at least be that amount and more rather than, oh my gosh, we just lost like 4% or something like that.
yeah.
Do you recommend, and I know there's guidelines and rules, but I guess you personally, do you recommend, or I guess what do you recommend for someone's percentage of income on a to spend on a mortgage payment? Do you have any tips or
Yeah, absolutely.
guidelines?
So as far as what your what you should be allocating towards your housing expense, a good ratio is between like 28 and 34%. I wouldn't go over 36. I try to keep it within 28 to 36%.
Yeah.
Ideally closer to 30 if you can. And
Hmm.
that gives you the ability to budget for other expenses that come down the road, put money aside in savings, pay off other debts, because you don't want to be, and the phrase would be, house poor, like where every single dollar that you have is going to your mortgage, right?
Hmm.
It doesn't leave room for anything else. And people want to live, people want to do things, they want to go out to dinner, they want to have fun, have experiences. So I mean, yeah, try and build that into your budget.
Right. And like you said, with car payments being 700 plus dollars, if you throw one or two of those onto your mortgage payment, you don't have a whole lot of extra cash laying around for your monthly expenses, and it can get pretty stressful if you cut it that close.
Yeah, yeah, and like I mean, right? Like groceries, everything's expensive right now, so you just have to, you have to build it in and budget. I mean, that's a big thing. I mean, obviously, like the guidelines allow you to go up to, you know, we'll call it 45% most of the time, and maybe higher depending on your situation, but you're stretching yourself. Like that's almost 50% of your monthly income just going to your housing payment. So yeah, like for me, I think that a good ratio that somebody should be sticking at is between 28 and 36%, and try to be closer to 30 if you can.
Do you ever come across, or when something comes across your email or slides across your desk, and you get someone's information and they're like a dream borrower? What does that look like? Is there such a thing where it's like, wow, these people
I,
these people have it going on?
Yeah, I mean, everybody looks. I mean, ideally, like if you have the money in the bank, you have 2 years employment history, and you have good credit. Like if you have all of those, that's a dream borrower, right? I
Yeah.
mean, having all the components ready and prepared. But not everybody's situations like that. I mean, that's the ideal. You don't have to have 20%. If you had 5% and had budgeted for closing costs, I'll take that as well. Like
Yeah.
it doesn't have to be the 25% down, 800 credit score, looking to buy, 750,000. So
Right. And
yeah,
so,
so
okay.
I mean, just
Okay.
I was gonna say, just having your down payment, having your credit, and then having a good, making sure you have a solid work history.
Hmm. And a lot of people, I mean, I used to listen to a lot of Dave Ramsey, and we paid off our debt,
Yep.
and I do not regret it in the slightest. Like it feels really good to not have debt. I'll say that. The
Yeah.
psychology aspect. It may not have worked out to the most potential, like from a financial. Maybe we'd be slightly ahead or something, but I'd be way more stressed. Um,
Yeah.
oh gosh, where was I going with this? I forgot what I was gonna say. Um, had to
Well,
do
so
it.
I mean, I got a thought on that. So
Yeah,
I think that it's a good thing, like to get yourself into a position where your debt picture is minimal. And for a lot of people, that can be challenging. But if you can do it, it's going to set you up way better long term because the interest rates on like credit cards are 20, average rates like 23.5% or
of
something.
course.
Auto loans are typically higher, but you're spending money on that interest, right? And most of the time it's money that's not going anywhere. Like credit cards, it's not an asset, it's just money that's being spent away if you're just accruing that interest. And then vehicles, like, yeah, we're in a weird time where some cars are appreciating in value, but it's
Yeah,
not always the case.
right.
But one thing you have to be cognizant of, and I had it happen with a set of clients, and they did the whole Dave Ramsey thing as far as paying off all their debts, having no debt. When they came to me, they had great jobs, they had all of their money set aside for a down payment, but one of them did not have a credit score because they had no active debt, which
Right.
isn't, I mean, you can make alternative lines of credit through utilities and that kind of stuff, but maintaining a credit card and a credit score can affect your interest rate. So, yes, pay off your debt, try to be debt free and manage it well, but like you got to have at least some sort of debt that's there, or
Can
you won't have a credit score.
can you do the manual underwriting like he talks about with Churchill Mortgage, all that stuff? Like, because I know we
Yeah,
were trying to get the
it
zero credit score.
yeah. So and it's possible, but then you have to provide. I mean, like a phone bill and then a utility bill and all these things, and we have to go down and basically build you a credit report,
Right.
and that's fine. But then it can affect how your mortgage insurance is as well. Like there's other factors that go into it. Yes, you can do a manual underwrite of the loan, but having, I mean, just like a secured credit card that's basically tied to a bank account that you replenish every month. And if you
Right.
just filled up your car once a month on that and have paid it off immediately, you're going to maintain good credit.
Yeah.
So,
Yeah. Okay, I knew what I was going to say. It was about PMI. And I think a
okay.
lot of people they focus on that 20% because they hear about this big scary PMI, which obviously it's not
Yeah.
ideal to pay, but I think that without knowing the actual costs monthly, it's a little bit scarier than it actually is. So like what's the typical
Yeah.
PMI look like for an average loan?
Yeah. So it is, so for an FHA loan, mortgage insurance is the same. Whether you have a credit score of 580 or you have a credit score of 800, you're going to get
Okay.
the same mortgage insurance premium.
Hmm.
Um, if you have a conventional loan, it is based on a handful of factors: what your down payment is, what your credit score is, um, what your debt to income ratio is. And the better credit you have, and not even the down payment, but if you have good credit, you get rewarded. It means that you have the ability or have shown the ability to pay on time
Hmm.
with other debts. And the mortgage insurance, like the premium itself, is going to be less expensive.
Hmm.
So, I mean, I've seen it on, I mean, $500,000 homes, the mortgage insurance is less than $100 a month. People have this idea that
Yeah.
mortgage insurance is like $200 or $300 a month, which for an FHA loan, yeah, it may have been in the past. It's not now, but it is. You get rewarded by having good credit. So a lot of people wait until they have that 20% down saved up. But if interest rates and prices are going up, I mean, you're going to lose out on that opportunity when you could have purchased maybe with 5% down, taken the mortgage insurance, and then refinanced it once you built in the equity
Yeah.
and not had to wait 4 years or 3 years to save all that money up just for the down payment. So there's an opportunity cost that people don't think about by just trying to save up for 20% to avoid the mortgage insurance.
Yeah. Okay. Yeah, that makes sense. All right. So what's next for you? Do you set goals monthly or yearly? Are you trying to beat the previous year every year? I mean, what does that look like? What is your yearly
Yeah.
mindset look like?
Yeah, so I mean, I try to plan goals every single year. And obviously, with the way the market has been, you have to adapt.
Yeah.
And I try to do my goal planning almost every November, so I know what I'm getting into and how I need to start my year December and January.
Mm-hmm.
I mean, for me, they're all, you know, uh, some of them are based on production and where I want my numbers to be, but I have a very simple business plan that I use that is like, hey, I want to get in front of, 5 financial advisors, and I want to make, 3 new real estate referral partners, and I want to make my social media grow to 1,000 followers, or my Instagram grow to 1,000 followers.
Right.
They're stuff like that, small goals that will hopefully help me hit my end goal, which is I'd love to do, 80 transactions, loan transactions every year, and have my production somewhere between 25 and 30 million.
Nice. Nice. That's pretty cool. And that's a lot of business. Why do you think people refer you, and why do people think of Chase when they're looking for a lender, or say as a realtor, like why did I send my client to you?
One, I'll pick up my phone on like in odd hours, and I know that people say that, but like if you call me at Friday at 9 o'clock, and if I see it's a real estate agent, they probably need something. I'll answer my phone, which
Yeah.
some people are like, that's not that big of a deal. But if you're trying to put together a deal at 5 o'clock or 7 o'clock on a Friday night, and your client needs a new approval letter because the other agent's asking for it to make sure that they can go up to that price, like you got to have somebody that's available to do so. So
Mm-hmm.
that's one thing, is like I'm almost always I will answer my phone. I think that we do a really good job at communication throughout the process, making sure that everybody's up to date and knowing what's going on. Where I think my strengths lie is I will always try to find a solution. And not
Mm-hmm.
only that, but one that meshes up with somebody's long term and short term goals. Because not everybody's situation is the exact same. Obviously, like the deal that we've got going right now, that's a unique
Yeah.
situation. These people have to, shuffle around and buy and sell, and they need to make sure that they're set up for the long term and make sure that it plans for them.
Right.
So that's one thing that I think we do really, really well. Is I'm not treating it just as, hey, this is one loan. We need to make sure that we're setting you up for whatever your long term goals are.
Right. No, I love that. I can attest to that. And I've been on both sides of it. And yeah, you've been fantastic. And I always know when I'm working with you, you're on the ball. And so that's what I appreciate too. So I'm happy to be working with you, especially in the real estate field, which is so fun. Okay,
Yeah.
we've talked about a lot. Probably have to do another episode at some point, but where can people find out where can people find out more about you? You were at CMG Home Loans, right? So how can they find you,
Yep.
learn more about you? Where are you at?
Yeah, if you just Googled Chase Altig, it'd probably come up. So you'd be able to find me at CMG Home Loans. If you want to find more information about, the home buying process, credit process, other little tips and tricks, Instagram is primarily where I'm at, and it's at Chaltig Home Loans. So CHALTIG _ home loans. So that's where I primarily operate as far as content goes, because that's where, I mean, I like to spend my time and put my energy towards. So,
Right. So if someone DMs you, you're on there. You can respond.
yep,
You're on your phone on the ball. Okay. Yeah, I love it. I
yep.
mean, you got a good thing going on. Go follow Chase. He's doing cool things, and he's very helpful. And in a world full of, maybe you would say, I'm trying to word it correctly, but maybe slimy, or maybe not like that, but we're both sales
Yeah.
professionals, and we do our best to be friends and treat you like we would treat our own family. And Chase does a good job of that. That's what I'm trying to say.
No, I get, yeah. So, like, my approach to everything is I want somebody to be treated the same way that I would like to be treated. I'm going to treat you in a manner that doesn't feel like you're and I like when people say it, like a number or a transaction. Yes, I
Yeah.
have ambitious goals of doing a lot of loans and helping a lot of people, but at the end
Yeah.
of the day, I have to do a good job, and I want them to feel taken care of. So, that's, yeah, for me, is like I want to provide stellar service and a total customer experience every single time.
Yeah, makes sense, and it totally shows. So if you need a lender, guys, hit up Chase. And I mean, if you need a realtor, I'm right here too. Um, but a little plug in there. But yeah, I think, man, we learned a lot about you, Chase. I'm really excited to share this with Spokane and get the word out about who you are a little bit more. It's nice to see, you can see someone on Instagram, you can see what they're doing, maybe see them in a Google search, but it's really nice to kind of get to know people of Spokane a little bit more. And I think we did a good job today. So people are going to get to know you.
Yeah, thanks for having me on, Reed. I really appreciate it.